Welcome back to the Self-Educated Economist channel. Today we're going to be more on macroeconomics. We're going to talk about what the Federal Reserve has said in their FOMC meetings. These guys meet every 6 weeks. It's the presidents of all the Federal Reserve banks which are scattered across the U.S. and they come together and discuss monetary policy and which way the Federal Reserve ought to go and what they ought to do. Most of the time you never hear anything about these meetings, but in times like we've been in with inflation running at 7.9% and the economy slowing down, these meetings come out and you hear quite a bit about them. So let's dive in here and see what they've been saying. In December, they said they were going to taper QE. And what this meant was in November they were buying about $120 billion in treasuries and equities a month, and they were going to taper that back down to zero. Okay, 6 weeks later, these guys meet in January. Now they're talking about running off the balance sheet and doing rate hikes. Now the reason they want to do rate hikes is Paul Volcker in 1981 raised the federal funds rate to 22% in order to break the back of inflation. And so that they want people to think they're doing something, so they want to do the rate hikes to try to break inflation now, which is running at 7.9% per their numbers. Well, after they have this meeting in January, they have to come back up for an emergency meeting in February. And in this meeting, they've changed their tune just a little bit. Instead of running off the balance sheet, which just means we're going to hold these notes to maturity, and what hedge fund managers call clipping the coupon on the treasuries, now they're saying we're going to drastically reduce the balance sheet. In other words, we're not just going to hold these bonds, we're going to sell these bonds. We're not waiting for that maturity rate on this bond to come in. We're going to put these bonds back on the market and sell them and reduce the amount that we're holding, which is a big difference between running off the balance sheet, holding these 10 and 15-year notes to maturity, and then drastically selling them. Now we have to keep in mind that the Federal Reserve is also buying mortgage-backed securities. They do asset swaps and they do mortgage-backed securities. They buy those. So we got to keep that in mind too. If they see the market going down, the value of those mortgage-backed securities going down, they might not want to hold them any longer. It wouldn't be profitable. And one thing we got to keep in mind is the Federal Reserve is a privately owned, for-profit central bank. There's nothing federal about them. They're not part of the government. It's not a branch of the government. They are federally owned. Or they are privately owned and not a federal government institution. Now let's fast forward up to March. QE ends about the 10th or 11th day of March. Somewhere in there, the Federal Reserve spent the last dollar they were going to spend on mortgage-backed securities and treasuries, and they said, okay, that's it. After that, they have their meeting and they're talking their rate hikes that we went over a minute ago. And they're saying they're going to get up to 2% by around July. All right. Well, what effects do these meetings actually have? And why are we paying attention to them? Let's look at the S&P 500. Now, I've drawn this chart. It's just a rough chart. You can pull it up and it's really choppy, but anyways, we started in December at 47.91. That's what the S&P 500 was bringing, trading at. And January 27th, after the January FOMC meeting, it drops down to 41.73. Then it goes back up just a little bit in February. Then we come crashing down. As the QE ends, we come crashing all the way down to March 14th at 41.73. And at the close of trading on Friday, March 18th, we were back up just a little bit. So around 4,300. So the S&P 500's taking into account that the Federal Reserve isn't going to be buying any more of these equities. They're not buying. They've not got their back. They started this program in 2008, 2009, and basically what they do is they buy treasuries and mortgage-backed securities off of the big dealer banks and swap it for a reserve asset, bank reserve, to try to get more liquidity, is what they said, in the system, and trying to get banks lending again. That was the idea in 2008 and 2009 when it was introduced. So, and now let's see where we're at. And we finally ended. They've done about 5 rounds of QE. So now we finally ended. Let's go on down here and check out these interest rates. Now what I've drawn is a rough yield curve. Normally, if everything was going smoothly, everything's going correctly, these interest rates would start low on the low end, on the short end. This is a 13-week treasury. And then it would come out, and then normally it would come up, shape upwards. Well, what we've got today is you got your 13-week at 0.38, the 5-year at 2.14, the 10-year flat at 2.14, and the 30-year at 2.41. So basically we have it coming in at 0.38%. That's 38 basis points of a percent on these U.S. Treasuries. And they come in and they come up to 2.14 by 5 years, and then they go flat. Now, why this matters is the Federal Reserve tries to control the short end of the curve with their federal funds overnight rate. That's the interest rate they're talking about raising. And what that is if a bank comes up and needs some, they either need liquidity, they either need money, or they need treasuries, because you got repo market and the reverse repo market. Then they go to the window at the Federal Reserve. The Federal Reserve will give them whichever it is they need. The transaction is usually an overnight transaction, even though they can be termed up to 2 weeks or 2 months. And the Federal Reserve sets that interest rate, and in order for them to borrow the money or the treasury, whichever one they need for their balance sheet, in order for, and hold it overnight. The next morning the operation goes, the transaction is cleared out, swapped back either for the money or the treasury plus the interest, and it's done. So this is the rate the Federal Reserve can control. And then, mind you, it's the only one on the yield curve that they can control. So as they raise the short end of the curve, as they raise this short end with the federal funds rate at, it was at 0, and then they were offering 5 basis points, 0.05 for interest on reserves. As they begin raising these interest rates on the short end, this end of the curve is going to come up. But the bond market is what's pricing in the long end. So, and what you get is if they got a higher interest rate over here, the bond market is saying we see more inflation and we see more economic growth in the future. From the outlook of what we've got right now, we believe that there's going to be more growth, and yeah, we're willing to put more money on this. Right now, with these rates low, they keep a low rate so that money can be gotten pretty easily. So if, because in good times you would have a good, an interest rate of around 6, 7, 8% would be a normalized rate. But when we're trading the 30-year at 2.4, then that's telling you that they're not seeing any growth, economic growth, in the next 30 years. By the time this 30-year note matures, they're not seeing any economic growth. And that's mainly what these bond yields tell you. Now, when one starts to flatten like this, they call it inverting, where instead of it coming up and around in a nice upward sloping shape, and it comes up and then goes flat, that's telling you we're getting ready for a recession. the people, the biggest pool of buyers in the bond market are saying, no, we're looking for a recession. And what this is they're buying this asset because it's the most liquid asset other than gold on the market. In other words, if I need cash quickly, I can get rid of these treasuries pretty quick. No, they don't have a whole lot of yield on them, but they don't see anything they're willing to take a risk on in the open market. If we were in good economic times, there wouldn't be as many buyers for the treasury yields. They would be taking their money and going elsewhere to try to get more return and more yield. But they see there's too much counterparty risk on the other side, so they're buying treasury yields, something they can flip pretty quick. So that's kind of a rundown of the treasury yields and what the S&P's been doing the past few months, and what in accordance to what the Federal Reserve meetings have said. So what they've said when they came out of them. For more information on the macroeconomics, and I also do some on personal finances and how you can use things to help you. Stay tuned to this channel. Please hit the like and subscribe button. Ring that notification bell for whenever a new video comes out. You'll be notified, and you can stay up to date on the economic side of things. Have a good day.